G'day, ladies and gentlemen. We're going to get started very soon. We're just going to wait 1 or 2 more minutes as everyone virtually files in, and then we'll kick into it. One of our panelists is just having some tech issues as well, so we'll just make sure he can connect, and then we'll kick into it. Just some general housekeeping as everyone's keeps filing in. If you do have any questions for us today, please feel free to drop them in the question box because we will get to them. We've been lucky that a lot of people have actually already submitted some questions on some of the feedback forms, which is great. But yes, if you do have any questions, please let us know. While we're coming in, I just want to make sure everyone can actually hear me and can see me. So if you can raise a hand on that GoToWebinar button just to show me you can hear me and see me, or even drop a comment to let me know that you can actually hear me and see the slides as well. Thanks, Reza. That's great, mate. Thanks, Caroline. Appreciate it. Just 1 more minute, guys, and then we'll jump into it. Appreciate your patience. Very soon, guys. Thanks for your patience while we just take care of a little tech issue. We're very lucky today. We've got expats joining us from over 22 countries. So we're coming from all around the world. Those that are staying up late in the United States, we really appreciate it. I've just gotten the go-ahead that we can kickstart into it as one of our panelists will be joining as his slides come up. So why don't we get started? Again, if we have any tech issues throughout it and you can't hear me, you can't see the slides, please let us know. Drop a comment in the chat box or a question just so we can tackle that straight away, just because I want to make sure everyone can see what's going on. And let's jump into it. So guys, welcome to today's webinar. We are completing part 3 of the series that we have been running, which is managing an Australian mortgage and property portfolio. We're focusing today on part 3, which is building that property portfolio. So going past maybe your first property, which might have been the former main residence or the investment property, then acquiring the next property. When we look at, I suppose, a bit of housekeeping, today's session is recorded. Those that are essentially attending and have registered, they'll be getting the recording first, and a copy of the slides as well. As we move through it, if something pops up and you have a question, no such thing as a stupid question, please drop it in the question box and then we'll address it at the end for a bit of Q&A. I'll now move over to the next slide. A disclaimer. What would a webinar be without an actual disclaimer? One of these pesky disclaimers that we always have to run through. Anything you hear today or see today should not be construed as personal advice, not at all. Today is for information and entertainment purposes only, or I suppose general information. If you do need some sort of advice, please do reach out and consult with your tax accountant, your buyer's agent, a mortgage broker, a lawyer, or a financial advisor. Who is the Atlas Wealth Group? Well, we are the leading provider of Australian expat, financial advice, tax, mortgage, and asset management services. We are regulated by ASIC, the ATO, and the DFSA over in the Middle East. We have clients in over 45 countries. All our specialists are undergrad qualified, as well as with numerous postgraduate certifications. Who are your panelists today? On the left-hand side, we have Jeremy Harper. He's the Managing Director for our Atlas Mortgages arm. Jeremy's actually got a bit of a unique background. He was formerly a chartered accountant, and then he moved into the financing space a long time ago, over 10 years ago. He also lived over in New York for a number of years with his wife. So he's been an expat, he's lived it and breathed it, and he understands a lot of the challenges that our clients go through when getting the appropriate finance, and that's why we love him. In the middle there, myself, James Ridley. I'm one of the directors here at the Atlas Wealth Group, mainly focused on the wealth management side. I'm formerly a tax accountant, and I guess I moved away from the tax side a long time ago, 10 plus years ago, when I felt I couldn't really help my clients as much as I wanted to, and that's what led me into financial planning formally. And our last panelist today, Jack Henderson, who is the founder and managing director for Henderson Advocacy. Jack started investing at a very young age and has amounts a wealth of over 25 million with his own personal property portfolio. So he does have skin in the game. He has his own strategies that he works with his clients on. And right now, Jack is mainly working with his team to help their clients, especially around the major capital cities, the major hubs. I think when we look at how much that team has transacted, it's now north of 450 properties, and we're all on here today. If we jump into today's agenda, we're going to be focusing on and touching on the interest rate landscape back in Australia, the outlook for the Australian property market, some financing opportunities, how to build on that property portfolio, opportunities when it comes to property selection, and lastly, some different tax and stamp duty considerations that I want to jump into, and then get wind up today with a bit of Q&A. So as I said, if you do have any questions, please throw them in that question box. No such thing as a stupid question. You'd be surprised. Let's jump into it. Australian interest rates. I'm going to hand it over now to Jeremy Harper.
Thanks, James, and thanks everyone for your time today or tonight, wherever you are tuning in. So the first section, I just want to give a little bit of an overview around where we are in terms of Australian interest rates. Obviously, it's the front of every news article currently, and everyone's talking about it. So, James, if you want to flick over to the next slide, just give you a bit of an overview around where we sit in terms of the current cash rate. So early November, we had the new governor decide to give us an early Christmas present, increase the central cash rate up to 4.35, and really that's off the back of that stronger, stickier inflation that she's noted. And we did, interestingly, we did have the October inflation readout just came today, which was slightly softer, showing potentially a little bit of an inflation softness around that 4.9%, but still in the eyes of the RBA, it is persistent, this inflation, which they're trying to get on top of via raising rates. Now, to put into perspective around how does this rate tightening cycle compare to previous cycles? So on the right-hand side, I think if we look at the cycle from 2002 up to 2008 before the GFC, I think that's a good comparison just around the duration. And you can see that red line, which is where we are currently, just how aggressive this rate increasing or rate tightening cycle has been compared to previous cycles. So and there's two factors really that is weighing on the Australian households. One is how quickly they've increased the rates in such a short period of time. And really the only previous cycle was the 88, 89 recession that sort of has gone beyond how aggressive the rates have been this time around, but also for a lot of borrowers coming off that COVID lending environment where a lot of people are on that super cheap fixed rate. So now we're seeing a lot of households adjusting from a 2% now to 6 plus 6-7% on their mortgages. So a big adjustment for households to digest over, I guess, the next 12 months. And so I think the question, if you look at the left-hand side, it's not necessarily when are we going to hit the peak? Is 4.35 the peak? Is there another one to come? you know, everyone's got their opinion and they always change it. The economists love to change every day. I think more the question should be, once we hit the peak, how long this time around will we hold rates? And I think it depends on who you talk to. People are saying maybe the first half of next year or the second half of next year, they'll start to cut. But I think if you go back to history in that 2008 cycle, they held at that peak for 5 months. So I think my gut feel is that maybe gives us a bit of insight to how long we'll hold rates. Maybe that'll take us to June next year, we'll see. But you can see that I'll get in some slides in a second, but it's really starting to weigh in on the household. So if you go over to the next slide, thanks, James. So what we've got here is to kind of give you an overview around where the housing rates are at the moment. So this is published by the RBA, and on the left-hand side, it talks about sort of where the variable rates have gone, and they move in conjunction with the RBA. So if you're an expat that's in the US, obviously there's a big difference between what the Fed does with their rates and what happens to household mortgages in the US. In Australia, that left-hand side basically says, as soon as the RBA raises by 25 or 50 points, you know, 2 weeks later, that is updated on the Australian household mortgage. So a strong correlation. So we're very sensitive to what the RBA does in terms of household debt. And on the fixed rates, I find this really interesting, where you can see with the outstanding loans, which is that sort of purpley line, you can start to see there's that hockey shape going up, that hockey shape J, where the outstanding loans, which means those 2% loans that originated during COVID, they're starting to roll off, and we're starting to see that average fixed rate now starting to jump up, getting up to that 4%, and then you can see there under new loans, the new loan costing on a fixed loan is now at 6%. So a huge difference between what people were on a fixed and what they can get in the current environment. And on the right-hand side, we've got the breakdown of CBA, our largest lender, and this gives us a good overview around where those fixed loans are and when are they going to mature. And I think that's really important to understand when we see the impact of these rate hikes on those mortgages. So you can see there June, which is just finished, and December this year. So December this year is the largest quarter. I think it's about 25-30% of their fixed loan books is going to roll off in the next 4 weeks, which is a bit of an early Christmas present for those borrowers. So in January, February, they're now going to have to adjust those households, going from a 2% repayment to 6.25. So we still have a bit of time to see this play out, the interest rate increases from the RBA, which will then continue to filter through in terms of consumption and other parts of the economy. So onto the next slide, just to give us an idea around where does the future market see the terminal cash rate, or the OCR, where do we see the peak? You can see there that dotted line that shows currently where the cash rate is now, and in the futures where that implied curve may hit. So it's sort of saying we're thereabouts, maybe another increase, maybe we're at the peak, maybe 4.5% could be around where we see the height of this cycle. And then you can see into the future over the next 12 months, potentially some cutting where that implied curve starts to drop down slightly. And then if we go over to the next slide, this graph gives a really good overview around what's the state of the Australian household. And so if you look at down below, you've got the savings ratio in that red line. Coming into COVID, you know, it's been well documented that households were flush with cash. People stopped spending. You can see that yellow consumption line that goes south. People stayed at home. The government gave us money. We stashed it all away in our bank account. Rates were dropped, so we had very little outgoings, high savings ratio. And you can see that line now is really starting to go south, when in fact we're starting to head into that sort of negative territory. And the reason why that's going south is if you go above and you can look at your disposable income, which is now still trending negative, so negative 4%. So it's showing that for a lot of households on the aggregate, for a lot of them now with the higher rents, higher mortgages, they've actually got negative disposable income. So their income is not covering what their outgoings are with the higher cost of living, the higher living expenses, be it the mortgage or paying rent over their head. So that's, the RBA does mention this at every meeting, and this is something to continue to focus on. And I think if you look at the retail sales have just been released this month, they went backwards. So this is now starting to filter through into other industries around consumption of households is starting to slow down because of those higher rates. And if we look at go across the next page, this is the quarterly readout of the inflation. So 5.6% is where we're at, or 5.4, sorry, the last readout for the quarter of September. We just had that recent readout of 4.8 for the monthly, which is not as accurate, but gives us a bit of an idea that potentially it's still trending down, not as quickly as the RBA would like. And I think a lot of that is driven by the fiscal environment that the Australian economy is sitting in. And I think some of those drivers are not going to go away in the next 12 months. The big ones are obviously rent. So if we change the page or go to the next slide, James, you can see that the rent inflation throughout the country, the major cities, is persistent. It's growing at a greater rate than the overall inflation. And that's a reflection of landlords having high interest rates, even council rates, insurance, all those higher costs are feeding, those input costs are feeding to the tenants, into the landlords, and a lot of that is passed on to the tenants. So I know a lot of the media is saying that it's really tough for tenants out there with these higher rental costs, but actually if you look at it comparatively compared to higher mortgage costs and holding costs, a lot of apartments or a lot of people would be still, comparatively speaking, still quite cheap to be renting. So I still think there's space, I'm sure Jack will talk on this later, space for that rental growth to continue over the next 12 months. And additionally, electricity costs, we've got that setting wrong. I'm not an electricity expert by any means. I don't really understand how it works, but the inflation between electricity and gas, it's 15, 18% year on year. So it's far too high, and higher electricity and energy costs is impacting the inflation around households and businesses, which is maintaining that high inflation rate that the RBA is concerned about. So that's me for this section. Over to Jack now to talk a little bit around the outlook for Australian property.
Thank you, mate. Can you hear me okay? I'm just unsure because I'm on my phone.
Yes.
Perfect. All right. So, Mr. Ridley, can you go to the next slide? Essentially, what I'm going to do is give you a high-level overview of the Australian property market. We predominantly specialise in the eastern coast of Australia. We don't do a great deal in Perth or in the Northern Territory. But the first thing I wanted to talk to is, I'm sure if you watch the mainstream media or read any of the newspapers or anything like that, every time we see an interest rate increase, and I've seen it, in the Australian media over the last couple of weeks, the headlines then begin: property prices are going to crash, and is the property run over? So I wanted to show you guys a bit of data which actually shows us that the last 6 times rates have increased, and this is not including the current rate hike. Property prices have actually grown as opposed to do the other, which is go down. And what that shows us is property prices in Australia are not just simply driven by whether interest rates are going up or whether interest rates are going down, or whether credit is easy to come by or credit is harder to come by. What we're seeing now in Australia is the migration numbers from overseas are well and truly outweighing the supply of available real estate in Australia. And because people or homeowners in Australia are living in their homes longer than they ever have, so over the last 10 to 15 years, home ownership as a year, like how long someone owns their home for, has increased from 8 years on average to now 13 and a half years. And that changes depending on where the person lives, but on average it's 13 and a half years, which means essentially Australians now own their homes 50% longer than what they did 20 years ago. And our building pipeline is much smaller than what it once was due to the increase in building costs. And now our immigration numbers are the highest they've been in a very long time, which naturally creates an imbalance between supply and demand, which is the main driver for property price growth. And in Australia, if you just click to the next slide, please, Mr. Ridley. In Australia, we've actually seen growth over the past 12 months, as opposed to a decrease like you might read in the media as well. So this graph shows us the total dwelling value for Australia. We can see back in June of 2018, we had a property market valuation of just under $7 trillion. Since 2018, so we're looking 5 years on, the property market is now over 10 trillion again. So you can see we hit a peak in sort of March of 22. We did dip there through I guess the early to mid parts of 2022 when the rate started to hike, and naturally buyers got a little bit scared. But then as stability has started to return to the marketplace, people understand what is happening now. And like I just mentioned, the supply of available property out there in the marketplace is almost non-existent. Now we're seeing the property prices nationwide increase again. And in certain pockets of Australia, we're seeing this, the increase happen quite substantial. In terms of if you go to the next slide, please, James. In terms of the 12 monthly change, so this is over sort of circa late 22 to late 23, which is where we are right now. I can't believe it's almost Christmas. Australia's risen by 4%, which again is probably contrary to what you're reading in the media. And you can see our combined capital cities, which is where we play, are up 5.1%. And then if we actually look into micro markets, and if we look at, say, Sydney as a marketplace, that's up 7.3%. We look at Perth, 8.8%. Hobart's obviously struggling. It's down 7%. Darwin's down 2.2%. And Canberra is down 3%. But the rest of Australia, on its median price, has actually increased in value. And then if we go even more micro than that, so obviously Sydney is a very large catchment. If we then go into, say, the eastern suburbs of Sydney, or the inner west, or the North Shore, or the hills, or all of these different pockets, we're seeing price growth with the same properties selling 2 years ago and then selling today. And we annualize that growth out. They've been growing at 15% to 20% per annum. And if we're talking the high end of the marketplace in any of the majors on the east coast of Australia, so Melbourne, Sydney and Brisbane, so anything circa 10 million plus, that marketplace is probably the strongest market or sub-market inside of Australia right now. So, there's a lot of really wealthy people who want to buy expensive property, and there is almost no supply, which is naturally causing significant demand. And when wealthy people want to buy a property, they'll pay what they need to get to be able to get it. Next slide, please. Thank you, mate. So yeah, the macro trends, like I mentioned, the biggest trend at the moment is just the imbalance between supply and demand. Again, I'm mentioning the media a lot, but it's because this is where most people derive their information from, whether it's true or not. If you were reading the papers back in late December, early Jan of this year, you would have probably seen headlines along the line, and Jeremy mentioned it in his little segment around fixed rates coming off, and the fixed rate cliff. When this happens, what's going to happen to the property market? We actually haven't seen that transpire, and now the same media outlets that 12 months ago said that there was going to be a huge market crash are now saying, well, that was just a myth. The issue that they don't report on is the overall lending, and there's a rough number, sits somewhere between $2.5 to $3 trillion. So that's residential lending in Australia. But as I showed you on 2 slides back, the market value of our assets, just our residential assets in Australia, is $10 trillion. Now, essentially what that's saying is we have a marketplace in Australia that has a loan to value ratio of 30%. Naturally, that doesn't reflect every single property in the market. There's a lot of properties that are owned outright, and there's a lot of properties that are probably geared 90%. But on average, if you had a property that was worth $1 million and you have $300,000 worth of debt on it, and your interest rate did go from 2% to 6.5%, and you had to sell, would you be worried? I would say probably not. Sell the house, pay the agent, cash out your $600,000 or $700,000, and you live happily ever after. So there will be a small segment of the marketplace that will be affected. And I would say they're people like the first home buyers who have leveraged up, 95% taken advantage of some of these incentives, and they don't have the mum and dad who can help them out. They might have to sell and take a loss, or some other people who have leveraged up and again maybe gone into that next price bracket, and they don't have a lot of equity in their properties. That their property might have come off 5 or 10%, and they are forced to sell. Obviously, they're not going to have a very good time in the marketplace. But we're talking about minorities here, not the majority. Like I mentioned, Australians are owning their homes longer. That's probably one of the biggest things that's putting constraint on supply, especially in established areas. A lot of people talk about the building pipeline and how approvals are at the lowest there have been, and this is council's issues, and builders can't afford to build anymore because of the price of things. That is true to an extent, but that doesn't affect established marketplaces. So if you're buying within 10 k's of Brisbane CBD, for example, and you're buying a house, whether 6,000 houses get built 50 k's from the CBD or not doesn't actually affect the micro market within 10 k's of the city. So when you're looking at all of this high level information, it's very important to contextualize it and really understand the segment of the marketplace that you're looking to get into. Where we're seeing a big opportunity, and we're going very hard in this space, both personally and for our clients at the moment, is unrenovated assets in all of the majors, so Brisbane, Sydney, and Melbourne. And the reason for that is because people have this idea in their head that, well, I don't want to buy an unrenovated home and then have to renovate it because tradies are hard to come by, building materials have gone through the roof, and it's going to cost me a lot more to not just in cash, but in time and in heartache to then obviously do the work. Where we see that as a huge opportunity because we're buying assets now. Let's hypothetically say we buy something for $1 million. We look 5 houses down the street. The renovated version just sold for 1.8 million. We know that we can renovate the property for say 400 grand. So there's a $400,000 margin in that property by just simply buying it and going through doing the work and then getting the equity uplift. So we're doing a lot in that space for our clients at the moment, where we buy, we renovate, and then we deliver the projects for our clients. Again, the A-grade stock, it's achieving incredible results. So anything that is finished in premium suburbs, in good school catchments, selling very, very, very well. And you wouldn't actually know that there are higher interest rates because there's just so many buyers who want to get into that kind of property. And naturally, if you're an investor, rental prices are the strongest they've been in at least 5 years. We have had a significant amount of rental growth over the last 12 months. Again, it's been reported a lot in the media that the poor renters out there in the marketplace, vendors are getting greedy. But something that they forget to report on, and I know that from all the assets that I own, we haven't seen much rental growth since sort of 2016, 2017. I know on my own properties, my rental income from properties that I was buying around that time was actually higher at time of purchase than what it was prior to this increase. So because obviously you had COVID, and during COVID, tenants took advantage of that and got decreases. So now I believe if you average it out over the last 5 to 10 years, rental growth is where it should be, but because it's come very lumpy, meaning we've seen the most of it over the last 12 to 24 months, they are very, very strong, and that's also pushing the rental market as well from an investor point of view, people wanting to now get into the marketplace. We're seeing a lot of older buyers or people who have cash also now starting to buy properties because yields are starting to become a little bit more attractive. On to the next slide, please, Mr. Ridley. You're up, Mr. Harper.
Thank you. Thanks, Jack. Okay, so now we're just talking a little about the finance opportunity. So if you're on the call, today we're talking about it's around building your property portfolio. So there is a bit of an assumption you've got an existing property, maybe you want to go 2 into 3. So if you change over the slide, Mr. Ridley, so really, if you've got say 1 or 2 properties currently, what can you do to continue to build this out? So a couple of things that I want to talk about at a high level today is obviously, number one, leveraging the equity. So there's no point having, particularly as rates have gone up, I've seen a lot of clients, obviously they're keen to pay down their debt, which is fine. But if you're building equity into these properties, and what has happened, as Jack mentioned, over the last 12 months, property prices have not only held their own, they've increased. So if you've had a property for a couple of years, no doubt there'll be equity in there, and we could definitely look to leverage that to continue your wealth journey. And that could be using as a deposit, it could be using as more than a deposit. Perhaps you've got enough equity to leverage to do a loan split to buy again on its own, or even look to potentially cash out. Now, there are some restrictions around that. Not all lenders will come to the table for expats, but there are options there. But say you want to do a cash out to, as my second point there, look to do some maybe non-structural renovations on that existing property, or you want to release some cash to continue to do some renovations on another property. Maybe, as Jack said, buy something where it's a bit run down, cash out on existing property, and use those funds to then build equity on that second property that you're doing the works on, and that can filter through into higher rental yields at the completion. A couple other things I'm seeing is people are using that equity perhaps on their existing one or two properties to then release that, gear up against those existing properties to then use equity to buy their quote unquote forever home. So it is a dream for a lot of expats I work with, is, you know, they've built some properties along the way, some investment properties, maybe they've done well for them, but not properties that ever live in themselves. But can they leverage that to then use as a deposit to perhaps stretch themselves to go into that dream home, maybe in Sydney, Melbourne, wherever they're from, typically grew up, that ideal home, and then using that cash flow as being an expat to pay down that loan whilst you're abroad, and then you've got, you know, that dream home to move into on return. And another option is looking at purchasing commercial property. So a little bit on that there. In terms of how you structure that, I did see, you know, there's a lot of, particularly when the rates are low, the only real option I was seeing was sort of a lease stock, where the commercial space, you want to go and buy, say, a warehouse, you've got a tenant in place, say it's a 5-year lease. You then, because you're overseas, it's harder to provide a servicing guarantee because a lot of banks still don't acknowledge foreign income in the commercial space. So what they'll do is they'll do a lease stock, which is essentially tied to the term of the lease, and there's an ICR coverage in place. But of course, what's happening with rates is, you know, with the RBA increasing the rates are up 4%. So your commercial bill that you're paying, or the commercial rate, you've blown your ICR coverage. So that facility, which may only be in place for 3 or 4 years, you're actually in breach. So in terms of long-term funding, there's probably a bit of an issue there, and how do you roll forward that facility and keep the bank happy? What I prefer is getting a client into like a term loan similar to a mortgage, 30 years, amortizing, or maybe interest-only facility for 5, but at least it's a term loan that's you can pay it off over that period, set and forget, as investment property secured against a warehouse. And in that scenario, yes, the rent won't cover off the mortgage repayment over that period. So similar to an investment loan, you need to show your personal servicing. There's some lenders that are now starting to come into space where we can use your foreign income to support that. So, you know, purchasing commercial property could be something to add to your portfolio. LVR is a little bit lower. You know, maximum you can go up to is about 75%, so you're gonna have to put in a higher deposit. But if you've got that equity on the resi side that we could look to leverage, that could be an option. Over the page, thanks, James. And so, you know, high level, what are some of the opportunities and challenges? Look, I think as an expat, particularly if you're in a tax-free or a low tax-free environment, it's utilizing your borrowing capacity. A lot of people in Australia right now, high rates, high cost of living, so everyone's borrowing capacity is being squeezed. You have to remember that any new loan originated right now, let's say the rate 6.5%, 7%, you know, 6.5%, 7%, it's still being stress tested. So as a borrower, you need to be able to qualify at a stress test of nearly 10%. So it becomes very hard to acquire new lending in Australia with the tax rates. So if you've got tax-free income, fantastic. That's going to set you apart from, you know, some of your competition who are on the Australian side in terms of their mortgages and what their borrowing capacity is. Property, great hedge against inflation in this environment. The ability to use the offset facility, which is really valuable for a lot of expats where they're moving funds across from overseas. Maybe they're taking advantage of a depreciated AUD, putting those funds in the offset account, which is reducing the interest charge on the Australian debt facilities. Leverage equity, which we've talked about, having that ability to come back to Australia when you're ready to retire, maybe sell down some properties, pay down some of your debt, and have that passive income when you head into retirement. And then increasing yields, as Jack mentioned, in terms of rental yields at the moment with that tight market. So what are some of the challenges? As I mentioned, it's harder to lend in the market overall, not just for expats. APRA is always there. So APRA is very conservative. It's very bureaucratic, a lot of paperwork. These people don't understand how the lending environment works. And what I mean by that is I've seen banks that have had to turn off lending to expats, not because there's any risk of default. In fact, I've spoken to people inside banks that the expat portfolio of loans, they're all performing, no one's in default, but APRA's deemed that as a risky type of lending. Not sure why. It's completely skewed against Australian property, Australian citizens, but that means that they've turned off the lending tap. So that's always going to be a challenge for expats. Banks will come in and out with their credit policy depending on their credit parameters, which is often driven by APRA because they're the ones that govern the lending environment. So that's just something to be mindful of. A bit of a higher deposit required, but if we've got existing property, as we said, you can leverage that up and use that equity. I think the biggest thing I see is sacrificing your expat lifestyle. It's all very well to go over. I lived in New York for a couple of years, enjoying your time overseas, but maybe drawing a line and say, okay, now it's time to invest in the future me. And what does that look like? Does that mean, am I going to take out another mortgage in Australia to get that second or third property? And if you just look at where rates are at, 6.5%, that property in Sydney is yielding you 3%. There's going to be a funding gap. So you're going to have to take money out of your personal cash flow to top up that loan. So it's more challenging for yourself around, are you prepared to sacrifice the current you and your current lifestyle? Maybe put on hold that European summer holiday to think about the future you. What are you going to come back to when you do come back to Australia, or what's 5 years going to look like? Government tax changes, well, that's pretty much for expats, as I'm sure you're aware, keeping up to date with Mr. Ridley's updates, but they're constantly changing property taxes at a government and state and federal level. So we've just got to be mindful of that, not just for expats, but for investors. It does seem like a bit of an easy kill for them to go after. And then challenges if you're looking to borrow with a non-citizen spouse, yes, it gets caught out with the non-res tax scheme. So, just have to work around how do you structure that. So over the page. Thank you. So now we're just talking about how to finance your property portfolio. So if we go over to the next slide, as we just running through some of these key points, as we said, looking at leveraging existing equity, using your personal income to drive your borrowing capacity. So particularly for expats in that low tax jurisdiction, if you're getting bonus income, how are we using, bonus income if it's been paid for 2 years and you work for an employer, that can be used as part of your borrowing capacity. So if that's something that's working into your personal income, fantastic. Looking at the asset selection. So as Jack mentioned, how can you look at purchasing and adding value to increase your yield? Because the higher yield on that property is going to help with your borrowing capacity on the next purchase. And also I'm working a lot with clients around, can they purchase in a family trust? And again, there's been some positive movement with some lenders around being a bit more open to lending to expats if they want to set up a family trust and maybe having a company. You just have to have a chat with your accountant around making sure it's compliant with ASIC, because there are some issues around being abroad. But from a lending point of view, we're starting to see some positive movement there. So that could be something that could help with your borrowing capacity as well. If you've got a property in an entity that takes care of itself in terms of positively geared, then that's not necessarily, some lenders won't factor that into future lending. Non-deductible debt and your borrowing capacity. So this is going back to sort of sacrificing now whilst you're overseas, maybe taking a larger mortgage for your future home. Whilst you're overseas, that will be set up as investment. So that is, you can take the rental income, but then obviously thinking about, okay, when we move back to Australia, what is the goals around that mortgage? Will you be paying down via some other assets? Will you be paying down via sale of other properties to pay down some of that debt? Because once you move into it, it then becomes non-deductible because it's owner occupied, and that interest doesn't impact your taxable income. Financing options, so yes, interest only is available if that's something that needs to be considered. P&I is obviously available. My preference is, particularly if you're trying to build equity, go into the P&I path, because that gives you the ability to start building that equity from day one a bit quicker, and it'll actually increase your borrowing capacity whilst you're in that accumulation phase. As we talked about, construction, subdivision, commercial property, they're all options. A lot of clients are looking at things like duplexes, granny flats, and what's really interesting is, just from my experience in the last couple of years with what's happening with housing in general, Australians' attitudes towards what they want to live in, perhaps as a renter, I think is different to 5 years ago. I think people would have turned their nose up at living in, say, a granny flat, but that's par for course now. So thinking about how does that work into your asset selection in terms of can you add additional dwellings to help with that rental yield ultimately. And then, and lastly, the importance of valuations. So, a valuation, you can do a digital valuation desktop, which will collate in data, or a short form. So that means you get someone goes out there, does a full report, and just remember that that's one person's opinion. And in this environment, they may be working for a valuer that at that point in time is incredibly risk off, so they can mark down that valuation report, not because of that property, but they might deem the market's too risky, so they'll give that a higher category rating, like a 4 or 5, and that particular firm may say, well, we've done our due diligence, we think it's worth 2 mil, they say it's worth 1.7. Now, quite often you might think that's a dead end. Hey, we can't get equity out, we can't proceed. Well, no, that's not the case. We look at other lenders. We look at getting an evaluation through a different firm with a different lender to see if we can get a second opinion that's maybe more in line with what we expect, and then we can continue on. So I think quite often, what I'm finding with lending right now is we may get a no with the lender, or may hit a couple of roadblocks, but we just have to keep trying to persevere through it. And if we keep going, we may get to what we need in terms of that result, but it's not as straightforward right now as put an application in, do a valuation, and everything will work first go. Over to the next slide. Thanks, James. So I think this is back to Jack now.
Yep, that's right. Yep, Mr. Henderson. Oh, Jack, you are on mute. There you go.
There we go. Can you guys hear me now?
Yep.
Beautiful. All right, so what I want to run through now, we've done some macro market chat. I want to run through more specific opportunities we see in actually selecting properties, and Jeremy ran through some really good insights there with what owner occupiers are actually open to living in now. So if you click next slide, please, James. Perfect. So essentially with property selection, one thing being overseas and trying to buy property back in Australia, or anywhere for that matter, if you're not actually there, I think carries a lot of risk. And the main reason for that is because on the macro, you can get into a really good suburb, and that suburb naturally does 80% of the heavy lifting when it comes to capital growth. Although in good suburbs, there can be a 50 to 100% price disparity just between streets. And I can give you some good examples. We talk about Vaucluse, for example. If you're on one street of Vaucluse, you get incredible views. You could be, on a street which is with some incredible people and all these things, incredible houses, where you could be 2 streets over and that house could be half the price because the locals themselves don't like that. So I think it's really important to get a deep understanding about the micro market and what the owner-occupier buyer wants in that market before diving in and buying something. Because, like I said, location does 80% of the heavy lifting, and if you're happy with an asset that has average performance, then that's awesome. But when we buy for our clients, we're really looking into, okay, we know what the owner-occupier buyer wants in a suburb, and then what are the things that they will pay a premium for? What are the things that are scarce in these areas? What are the best streets? All of these little 1%ers is what makes that property outperform then over the next, say, 10, 20, 30 years. With property selection, for the most part, you've got established real estate, meaning property that is built, it's depreciated fully or is half depreciated, and then we've got new build property. New builds are something that I am very against, especially when it comes to apartments. I mean, if you're looking at a duplex, for example, in a really good suburb, there's less room for error. Or if we are looking at brand new apartments in high density blocks, which is what a lot of people I know from overseas buy, most of those properties, if their investment purposes, underperform in the long term, just simply because they have a complete lack of scarcity. And as soon as there is more demand for that kind of stock, they just meet that demand usually with more supply. So ideally, I would say for investment, avoid brand new apartments. We've obviously got metro and regional. For the most part, metro property in the east coast of Australia is quite expensive to most parts of the world. So a lot of people now are opting for regional properties because they're cheaper and they're obviously easier to afford. 80 to 90% of what we buy for our clients is regional property. Metro property. And the main reason for that is because we're very focused on trying to minimize our risk when we're investing. So with regional properties, if we look at a track record of a regional location, and we do that with our clients when we're showing them reports of locations, they'll come to us and say, hey, Jack, or hey, team, I've heard of this area or that area that's grown by a significant amount over the last couple of years. What do you think? And we don't just share our thoughts and our feelings, we show them data. And what you'll see is in COVID in Australia, most locations grew. It doesn't matter where the property was. You could have been in the middle of nowhere and you still would have gotten growth, but it wasn't market driven. It was just simply because there was so much credit and so much easy money out there in the marketplace. Properties felt the uplift of that. But if you look 5, 10, 15 years before COVID, a lot of those regional marketplaces were very, very flat. And for us, essentially what you're saying then is by investing in a regional location is I am betting on something to happen in the future that hasn't happened in the past. And for me, that's a risk I'm not really willing to take for myself, nor am I willing to take that for our clients. So it's always about understanding what's the track record been of that location. And really good quality locations usually perform better in the future than they have in the past. So if you can look at an area's, say, 30-year track record, the data in that area, and it's had 6 or 7% growth compounding for the last 30 years, I'd be very confident to say that the next 30 will probably be better, just simply because we're going to have a greater population, the properties are going to be more scarce, and naturally they're the two big drivers for growth. Demographic factors, again, this is not revolutionary stuff, but it's really just putting yourself in the shoes of the owner-occupier demographic inside of that location. I'm talking obviously investment here specifically, but what a lot of people do when they buy investment properties is they think, oh, well, I'm never going to live in this property, so it doesn't matter. Whereas I think that's the absolute wrong approach, because if you're from a good demographic and you live in a nice area, for example, you want to be buying an investment property that is something that you would actually want to live in yourself. And when I say you want to live in it yourself, I don't mean the style of the home and the carpets. I mean, would you live in the suburb? Do you like the kind of people you walk past when you walk down the street? Go to the local shops. Do you like the amenities there? Is it close to work, or is it close to the work of people similar to yourself? So all of those kinds of things is how we go about selecting assets and selecting locations. The macro and the micro on location, I mentioned this at the start. People understand the macro location, and we're seeing this a lot in Perth right now. Perth's got a lot of hype around it. You would have seen on that data that I showed at the start, it's actually had the strongest performance over the last 12 months. It's grown at almost 9%, but very few people actually understand Perth on the micro. And again, if we look at Perth's track record, it's very poor. And the main reason for that is because up until this point, it's been very reliant on the mining industry. And naturally, the marketplace is very reliant on one industry, and an industry that is obviously cyclical. When that industry starts to feel the effects of a slowing economy, obviously the property market feels that. So really understanding your marketplace on a micro level is very, very important. Scarcity factors are a really big one. You know, we want to understand what the owner-occupier buyer wants at a high level. So do they like a house or a townhouse or an apartment, for example? In Bondi, most owner-occupiers want to live in apartments. They want to be close to the beach. They want to have a set and forget. They want to be able to lock the door behind them and not have any maintenance because they're very lifestyle driven. Whereas if we go to Brisbane and we go in a similar location to Bondi, you know, a few k's from the city state of New Farm, very few people live in apartments in New Farm. So if you bought an apartment in New Farm, you'd probably buy an asset that had underperformed that suburb. So you'd buy a house there. But that's at a high level. And the scarcity elements are, well, what are the properties that owner-occupier buyers will pay a premium for, and they will continue to pay a premium for, because there are so few of them. And things are, or the main thing, sorry, that we look for are character style properties, because obviously the homes they build in 2023 are very different to the homes they built in 1920. So character style features, level blocks of land, a north facing rear because of the sunlight, a functional floor plan, off-street parking, tree-lined streets, all of these things will add scarcity to that property. And I think the misconception people have with this is you will pay a premium for it. Like, that is a given. If you're buying a really good quality property in a good quality location and it's got all these scarcity drivers, you're going to turn up to an auction and there's probably going to be 10, 15, 20 other buyers that are going to try and buy that property. Although in 10 years time or in 20 years time, the 10 or 15 buyers that are trying to buy it today, there'll be triple the amount of buyers trying to buy it because our population will be 3 or 4 times as large. So it's about understanding that I'm happy to pay a premium for something now because that gap is only going to get larger over time. And the easiest way to, I guess, contextualize this is just to look at the best suburbs in Australia. Your Point Pipers, for example, your Toorak's. These are extreme examples of it. But the reason these properties become more and more and more expensive, and the gap between a normal price property, so the median price property, say in Sydney, is just over $1 million. The median price a house in Point Piper is probably 60 million. And that's because the demographic of people who live there and the scarcity of the property. There's 200 homes in Point Piper. So it's about taking that criteria and then implementing it into an area which you can afford. And then long-term performance. So making sure that we're tracking long-term performance and not looking at short-term data. I'm not sure if anyone in the webinar knows Charlie Munger, which is one of the founders of Berkshire Hathaway, one of the largest investing firms in the world. He actually passed away yesterday, which is very sad. But one of the fundamentals of their investing strategy, and the reason they're the most successful investors in the world, is because they think very long-term, and they are the masters of understanding history and how that impacts our future. And that's what we're very big on, is understanding, well, what has an area done for the last 30 or 40 years, and are we confident that it's going to do that for the next 30 to 40? I think this is you, Mr. Ridley.
Yes, mate, it is. Thanks for that. Sorry, I've had slippery hands and actually bumped the mouse then. But I mean, for those that are listening,
I might have been ranting, I think. So I'm glad.
Giving you the wind up. But a quick shout out for those that are listening and tuning in. I'd highly recommend you actually follow Jack and his firm on LinkedIn, because they actually post up case studies and what they do, how they help their clients, and some of the results are actually amazing, especially the capital growth uplift that we see. So I'd highly recommend, if you are looking for some more content in your day, that there is just some really good results that come out from that. What I'm going to talk about today is different tax and duty considerations. I suppose when it comes to growing your property portfolio, having a really sound understanding of tax is really important, just as you continue to navigate that space, even down to land tax. Remember, if you're buying multiple properties in the same state, it's very likely that that's going to increase the total taxable value of the land in that state, and therefore you'll attract some land tax, depending on how you're owning those properties. As an example, Jeremy said it before, non-citizen spouses, that can sometimes attract these extra surcharges as well. So if you are investing and it's purely an investment, it shouldn't be an emotional decision. It should be more logical, ticking a lot of the boxes that Jack just went through, and therefore you can diversify across many states, which ideally reduces those kind of land tax payables that you receive when you're an investor. Jumping into the first one, the main residence exemption. It is something that we all still get as an Australian tax resident, but when we're a non-resident, they did remove it back on the 30th of June 2020. However, using the main residence exemption, you still can use it as an Australian expat, as a non-resident. And as an example, if you buy a property today, or 5 years ago, or 10 years ago, you moved into it, you lived in it for a few years, and then you've moved overseas and now you're renting it out, you can rent it out for technically up to 6 years and then continue renting it out, and then say when you come back to Australia, move back into the property, and essentially the period that you've lived in it plus 6 years will all be tax-free and tax exempt. So often I think a lot of Australians or expats in general think they completely miss out on it now that it's been removed. But the only, I suppose, takeaway from them removing the MRE for Australian expats is if you're selling that property and at the time of sale you're a non-resident, then that's when you will not be able to access the concession. So that's the key takeaway there. If your goal right now is just to keep building on your property portfolio, using equity to refinance and fund the next deposit and so on and so forth, then keeping the main residence makes sense. You can also reset. You can come back and you can rent out the property for 5 years, move back into it for a year, and then rent it out again for another 6 years, and it's still tax-free. I've got clients that have been doing that for the last 15 years because they were fortunate enough to buy at the right time in the right area, and that asset has gone up the most from a capital appreciation aspect, but they're trying to keep it tax-free. The hardest thing is just the change of residency, and obviously in the future there are going to be some changes to our tax residency rules, and I think everyone's a little bit worried about that in the long term. So we might touch on that. I think I saw a question come through on that as well. Let's talk about briefly capital gains tax. Capital gains tax in Australia, we don't have different tax rates for capital gains. Capital gains are just taxed under ordinary income tax rates. There are concessions that we can sometimes access which reduce the taxable component of that capital gain, but often if we're selling as an expat overseas, a non-resident, we will pay tax at the non-resident income rates, which I will show you very soon over the page. And then again, capital gain is just treated as ordinary income. The one concession that we still can use on a pro rata basis is what's called the 50% CGT discount concession. Unfortunately, that was removed 9th of May, but you do get access to that for the period that you've owned those investments as a normal Australian tax resident. So to give you guys a bit of an example of what that means, I'm a normal Australian tax resident right now. So if I buy an investment property, I own that property for a number of years, say 5, 6, 7 years, and then I sell that asset. And out of the 6 years that I've owned it, for 1 year, I was a non-resident. Well, then 5 years worth of capital growth, I'll be able to discount by 50%. And that last 1 year, I won't be able to. So that's what I mean by pro-ratering, which means a lot of the capital gains will be exempt, but a portion won't be. That concession is great, especially with property. I think whenever we're coming up to a budget or there's a new government coming into power, we're always a little bit concerned that they are going to play with that 50% CGT discount concession because it is such a great tax concession that we can access, especially for the long term. With the CGT discount, market valuations can definitely help segregate those periods of residency versus non-residency. I think one of the probably common valuers is Option Solutions or maybe BMTQS. They're pretty popular on a national basis here around Australia. Let's jump into a little bit on positive cash flow properties. And often you might hear these called positively geared properties. But there's technically two types of positively geared properties. There's positively geared where you're getting a tax refund, and then there's on a cash flow basis, it's completely paying for itself. So when we hold those kind of properties, we will pay income tax rates at the non-resident rates, and right now they're on your screen. So 0 to 120,000, 32.5%. So rather punitive tax rates compared to our normal, traditional Australian tax resident rates. And there are ways that you can mitigate that cash flow and reduce that tax burden. The probably simplest one for expats is actually making what we call a concessional or before tax contribution into your super. That's starting to become a really well-known, renowned strategy for expats to net off their income. By doing so, it means rather than paying 32.5%, you're only paying 15% tax through your super. So you're effectively saving yourself 17.5% immediately. And when you zoom out, it means you've got a great property asset paying into your retirement asset and funding it. And you've got to remember that now that you're overseas, now that you're no longer based in Australia, you no longer have, I guess, the scenario where your employer is putting 11% into your super funds. So, you've got to work out other ways to keep growing your wealth, whether it's through your super fund or through your property or properties in the future. And then there might be an exit event when you look to sell out, move a bit into super, and then shore up your retirement. So it really just depends, but that's a really good strategy that we see a lot of clients using. Jeremy briefly touched on this before, an offset over a redraw. And I see a lot of expats get it wrong when we're having our initial inquiries and clarity and discovery calls. And it's mainly just because the unknown, not knowing, I suppose, the benefits. Often we see a lot of expats throw a lot of money into the redraw account, but if they could have, they should have put it into the offset account. But if we just run over what an offset account is, so it's a separate non-interest bearing account linked to the mortgage. Every dollar that you place into that offset account reduces the interest that you'll pay on the principal amount of the mortgage. So quick high level example, you've got a mortgage worth 500,000. You've got, say, 150,000 in the offset account. It means that you're only going to be paying interest on that 350,000. So for every monthly principal and interest repayment that you're making, you're actually attacking and winding down the principal a lot quicker. That's great because it means by doing so, and if you're doing that for a few years, you're winding down the principal quicker, but it also means that your equity in that property is growing at a quicker rate, which means you'll be able to ideally refinance a little bit quicker if you want to keep growing your property portfolio and buying another one. So that's how you've got to layer your decision matrix when you're structuring your finances. When returning to Australia, funds can then be pulled out of the offset account to use for the main residence purchase. The interest expense for the tax deduction purposes will go back up because it's tied to the investment property and therefore 100% tax deductible. If it was in a redraw account, wouldn't be the case. And the reason for that is you're pulling funds out of a redraw to say buy a main residence, but a main residence isn't not an income producing asset, so you don't get the tax deduction. So it's just trying to be a bit more debt wise and make sure we're structuring things correctly on the re-entry back to Australia. That's exactly what I just said. Purpose of funds, is it income producing or non-income producing? So no tax deduction. The next slide is talking about stamp duty. Jeremy mentioned this before, I was going to talk about it. I won't harp on too much about it, but when we look at different states, and if we're buying with a non-citizen spouse, we do attract a foreign acquirer surcharge. New South Wales and Victoria, they are the worst. 8% additional surcharge on top of your stamp duty. So that's a lot. And I've got a great example on the next slide. And we can see there that there might be a scenario or a strategy that you can employ to maybe not buy initially with your non-citizen spouse. And I'll jump into that right now. So this is a live example of a client recently purchasing a property in New South Wales. The purchase price was $2 million. They were buying or looking to put their spouse on the property just as joint tenants. Spouse was a non-citizen. Because they were non-citizen, it attracted that extra 8%. Now, because their ownership was only 50% in the property, that means only 4% in terms of the extra surcharge that was getting attracted to the purchase. So essentially an extra 80,000 in transfer duty by having the spouse on the property. But our recommendation was don't do that. Your intention is coming back to Australia in about 2 years' time. Why don't we look at adding the spouse at a later date when you've gone down the pathway of permanent residency, and then it's not an issue. It's not an issue at all. We can actually, most states have a spousal exemption, transfer duty exemption, by adding them onto the property when it's your main residence. So that's a really important one, making sure that when you're buying, you're buying and structuring it in the right manner, so you're not paying these ridiculously high surcharge purchase duty costs. So just be mindful of that. I've seen clients already caught out by it a long time ago, but it just means changing sort of your thinking and your thought line when first growing that property portfolio a little bit. In terms of property ownership types, well, the two most common, joint tenants or tenants in common, very different. Usually if we're buying a main residence or a future main residence in Australia with our partner, usually it'll just be joint tenants. And it just means that we've both got an equal interest in the property. All joint tenants acquire their interests at the same time, and there is the right of survivorship. So that's probably the most important one when we compare these two. If one tenant dies or one joint tenant dies, automatically the remaining tenant receives their share. It's not a CGT transaction or anything like that. It's just automatically right of survivorship done. So that's a really important one, and you can see some issues come about with tenants in common. Tenants in common, very different. You can own properties in fractions or different percentages, 60-40, 1/3 each, but there is no right of survivorship. So it can actually create some absolute estate planning nightmares if not done correctly. And I'll just read it as it is. Unlike joint tenancy, if a tenant in common dies, their share in the property forms part of their estate and can be passed on according to their will or the rules of intestacy if there's no will. So, I mean, what we often see when we're buying tenants in common, that might be because we're buying with mates or other family members, and we want to own different shares based on the deposit and the cash flow that we're bringing to the table. But you need to have some sort of agreement in there in terms of what happens in the event someone passes away as part of that long-term estate planning. A really good example of what that might look like and what I've seen up close is we had a client, they owned a property with their brothers, 1/3 each, so 3 brothers. One of the brothers passed away due to an illness, and within his estate, he left everything 1/3 to his kids, and that included this property. So the kids each got 1/9 of his ownership, and the remaining 2 brothers still own 1/3 each. It doesn't matter how much you own when you're a tenant in common. You actually are still entitled to equal rights in terms of voting and what happens with the property. You can technically put a loan on your share using the lender. So long term, it can create a lot of issues if it's passed down generations. I've seen one where it was 1/32 or 1/32 of a share, which I thought was pointless. But that's what can happen with tenants in common when the right and appropriate planning isn't done. It can just trickle down to each generation and sort of get carved up again and again and again. So plan accordingly when you are going to look at doing so. That's actually the last slide from me today. I wanted to drop some other feedback in there from earlier before, but we'll move into the Q&A section. So if you do have any questions, I'll start reading them out very shortly, as we do have a few. But one thing that Jeremy was talking about earlier was looking at, over the past 40 years and looking at different rate hike cycles and how long they might last for. So we actually looked at some data a little while ago. I was actually crunching some numbers for a client, and I went back 40 years. And I wanted to look at, through different rate cycles, how long do interest rates stay at their peak on average, and what's sort of been, the lowest that they've stayed at their peak, and I guess the highest over the last 14 years. So remarkably, interest rates have hit their peak in the past for a maximum period of 16 months before the RBA cuts. And then the shortest period was only 4 months. So the average there was 10 months. And this is looking at about 9 different rate hiking cycles. Through most of those periods, property either stayed at 0% or it actually went up. So that's a really, I suppose, good example that property is driven by a lot of other factors, not just interest rates. And Jack touched on it before. We've got a huge issue right now with housing supply and massive migration numbers, which is really good for Australia, but massive housing shortages causing low vacancy rates. I was having a call with a client earlier today, and they were saying that they're still seeing massive lines for rentals out the door. And as soon as a sort of a property in a good area goes up for sale, it's snapped up within 5 days. So they say it's not even worth looking at it because it's just, you usually get priced out. So market is still hot in several areas. So yeah, and one thing you've also got to remember around this time, and it's conversations I'm having with clients right now, is interest rates are high. I think this causes this, I guess, a bit of fear. And you've just got to remember that interest rates aren't going to stay at their peak for long, maybe 12 months, maybe, but as rates come back, if you're only buying when rates come back, well, you're not the only investor that's going to be thinking the same thing. You've sort of got to look at buying in the market when rates are high, because that's when there's a bit of fear there. It's the same with share markets. Everyone panics a little bit when there's a big share market drop, but the right investors, like Warren Buffett, he buys a lot at that point in time when markets hit their low. And it's just one of those things where the property market hasn't seen a low, but people are a bit nervous because interest rates are high. So if you're still, I suppose, being financed and you can get credit, then it's not a bad time to consider investing, because when interest rates wind back, that's when property will lift, and it always has. We'll jump into some questions. I've got the first one here for Jeremy, and I'll just throw it over to you, Jeremy. Is Jeremy able to walk us through the mechanics of pulling out equity out of an existing property and then buying an additional property? Is it a new refinance? Is there sort of 2 different or 3 different components of the loan? Is it just a normal loan process? Over to you, Jeremy.
Yep, good question. So look, it depends on the lender. So if the existing lender is expat friendly or suitable for your circumstances, as in they'll support future borrowing, we could go back to that same lender and do a loan top up. So that would be a new loan. So you'd have 2 loans. Let's say hypothetically you've got 1 loan against the existing property. We would do a second loan with your current bank. Let's say that's for 200,000 to pull the equity out. And at the same time, I would do a pre-approval for the new purchase. And then the reason why, because you want to make sure that we can show the bank we can afford both the equity release plus the new loan and get those both approved. And then depending on the bank, they may just give you that cash. Let's say it's 200,000, they'll maybe pop it in your bank account, or they may say, yes, you're an expat, we've approved it, subject to you showing us the contract for the new purchase, and then that will get released at settlement. So that's more just a technical how that specific bank wants to deal with it. If, let's say, for example, that your existing bank's not friendly towards you in terms of your borrowing, or maybe the valuation's not great, then yes, we could go and look at other lenders, do a refi, do an equity release. So it would be similar in the sense that you'd still have 2 loans against that property 1, but we'd do that as a refi, and then you'd have the pre-approval, which would be secured against the second property.
Yep, great. And then another one for you, Jeremy, was actually about interest-only loans. Do they still exist? And what are you seeing right now in terms of common lengths of time? And is there sort of a sweet spot that you're seeing banks are happy to lend for?
Yes, so it's still being done, particularly for investors, up to 5 years interest only. What you've got to be mindful of, I mean, there's not much of a premium, maybe 20, 30 point premium on investment P&I rate, so it's not a huge difference. It's more just around the serviceability. So let's say we're trying to refinance that current loan and you want 5 years interest only, and hypothetically it's going to be a 30-year mortgage. They take off the 5, so you would have to be assessed under a 25-year P&I loan, and then they'd stress test that. So if it's 7, stress test 10% over 25 years, so it becomes a little bit harder to qualify under interest-only lending versus P&I. But yes, if you want to, not all banks will do interest-only lending for expats. A lot of them will have policies say, yes, we'll lend to an expat, but P&I only. But yes, there are lenders that will do IO up to 5 years as an expat.
Yep. Okay, great. And then, Jack, you provided some really good insights on just how you and your team and what you're doing for your clients right now. Just a broad-based question: is Jack and his team focusing on particular types of properties at the moment, like apartments or townhouses? I think you sort of already maybe addressed that question, Jack, but I might just throw it over to you again about what your focus is at the moment with your clients.
Yeah, legend. Great question. And I think the issue with this question, and it happens a lot, it's very short-term thinking. So just the question itself, what are you focusing on right now? With real estate, it never changes. So when I usually get this question, I will throw the question back on the person who asked me, and if I said, if you had an unlimited budget, where would you buy? And they usually say the best suburbs in Australia. And I said, and then I usually reply to that question is, and in 10 years' time, if I ask you the same question, would you buy in the same place? Their answer is yes. And I say, that's the philosophy about investing. You always want to buy the best quality asset you can buy in the best quality location. Now, the thing that will change is your availability to get credit. So your first purchase will, unless you have an income that is significantly growing or a business that is significantly growing, will likely be, the most servicing you will get. So you just want to make sure you buy the right asset. So for us, it never changes. It's the best house in the best suburb in the best area that client can afford. Whether it's a house, whether it's apartment, is more market specific as opposed to timing. So like I said, eastern suburbs of Sydney would absolutely buy an apartment. Brisbane, no, I wouldn't. Melbourne, no, I wouldn't. Newcastle, yes, I would. So it just depends on the marketplace that you're buying into. That is obviously dependent on your budget and where you're at in your investing journey. But I buy the same assets every single day for the rest of my life.
Great. And another question, actually just a comment here. For those that are on the line, this session is recorded. So recordings will be going out, I would say in the next day or two, and so will a copy of the slides. Some good questions here that have flown in around residency. Deanna, I'm just going to read it out as it is. So I'm an Australian, not currently an Australian tax resident. So I'm a non-resident residing overseas. I'm interested in buying a property in Australia, but I'm concerned about accidentally becoming a tax resident from domicile test. What steps should I take to avoid becoming a tax resident? Well, Deanna, there's a few things that definitely factor into that. I think probably right now, when you look at the modernising tax residency rules and those 4-factor tests, right to reside permanently in Australia, so that's going to capture all Australian citizens. I think the key caveat there is whether they're probably going to introduce this 45-day test or whether they're going to push that out to 90 days. But then when you look at the other factors, which is Australian accommodation, Australian family, and then Australian economic interest, I would say a lot of people are accidentally going to probably tip over the economic interest because there's rumours that they were going to include a bank account in that test with significant savings, and there's rumours even an Australian super fund. So if you are going to buy just an investment property and not sort of breach those other rules, I don't think you'll have an issue around residency. You definitely still can own property back in Australia, live and work overseas, and still be a normal non-resident. I think a lot of our client base, 85% of our client base is. So it's not an issue yet, but it's definitely one of those things we're keeping an eye on with regards to the modernising tax residency rules, which are coming through. So good question there. I'll jump into another one. Martin's dropped in a good one, and I think this will be for you, Jeremy. With regard to offset accounts, St. George is removing the offset accounts. Do you know if this is a trend that we'll see coming across other banks? I didn't know that. Jeremy, have you heard of that? St. George removing offset accounts?
It might be product specific. So maybe go back to St. George and see. So for example, say like with Commonwealth Bank, now if you take out an offset account, it's against under the MAV package, so the annual fee of $395. They used to have what you call a miser account, which they're sort of phasing out. That's not as common, though some people still have them. So that might be a case that the specific product is being phased out. But no, St. George are still offering, well, particularly offset accounts to borrowers in Australia. In terms of are they restricting it for expats, I'd have to look into that. Maybe if they want to drop me an email, I can ask my rep on that one specifically.
Yeah, no worries. Yep. Another good question here in terms of Dean, just I suppose a general one. I'll read it out. Any thoughts on an expat just before repatriating, taking out a cash out refinance on an existing property to fund another property purchase, albeit property yet to be found, just to secure funding in case of limited income proof after repatriation? Jeremy, what are your thoughts on that one? Getting a refinance done before coming home because of maybe being unsure of work when they come back to Australia?
Yeah, so when you do an application, there's a question, do we foresee any change in the next 12 months? So obviously, if you're on good income overseas and you've got great borrowing capacity, take advantage of that, because the banks will do the assessment as the ball lies. It's not regarding what's going to happen in the future. So yes, you take advantage of that, but then separately, if you're going to take out higher borrowings and there's an expectation you might be, let's say, one out work in 6 months' time, just being prudent, you've got to make sure that you've got the cash flow to support that mortgage repayment over that period of time, because you don't want to be, taking out a new $1 million mortgage and then they've got no personal income to support that, because then you're going to get yourself in some trouble. But yes, that's something you could look at doing. I know plenty of expats have done that, where perhaps they've bought another investment property, moved back to Australia. Maybe someone, let's say it's worked in tech, they've got the cash in a bunch of, say, restricted stock units, so they've got quite a bit of asset to live off, and they just want to take a bit of a career break for 6-12 months. But obviously, if you're back in Australia trying to apply for a mortgage whilst you're on a career break, you're not going to be able to borrow. So yeah, that does make sense. It's a good question.
Yep, great question. Another question here, and Jack, it's mainly that they came in late and they sort of captured half of what you're talking about in terms of some of the types of strategies that you run with clients. You talk about sort of the types of properties you like and focus on. What about strategies? I came halfway through when you were talking about renovating.
Yeah, so essentially where we see value in renovating is that at the moment there is a mentality out there in the marketplace that building is very expensive and building materials is very expensive. So the disparity between, let's hypothetically say you've got two properties side by side on the same street, everything's the same amount of land size, floor plan, everything. The renovated property, if it went to market, would have 20 buyers trying to buy it. The unrenovated property, if it went to market, would have 2 buyers trying to buy it. And the disparity between what the renovated property will sell for and the unrenovated property will sell for is usually much larger than what it will cost you to do the work. So we see value in buying the same assets, like there doesn't change in terms of the fundamentals that we follow, but if our clients have good equity or good cash available, we will tell them to have a lower purchase price, because you're going to buy the unrenovated property lower than you'll buy the renovated property, and then renovate it themselves. Because the worst case scenario is, let's hypothetically say you spend $200,000 on a renovation and it only adds $200,000 worth of value to the property. You can still cash out 80% of that new value, pull out the majority of the money that you spent on the reno, and still put that into the next one. Plus, you're going to get an uplift in rental income. Plus, you're going to get the depreciation benefits, and you're still going to have the majority of the cash sitting in your bank account. Now, our philosophy with renovations is we want to make sure that we call them the accelerator assets, because they accelerate your wealth creation journey, because you're not relying on organic market growth to be able to get into your next one. So we want to make sure for every $1 we spend on the reno, we get $2 in return. So then, I guess, to go a bit deeper into that, the way then we go about buying those renovator assets is to make sure that to get the $2 for every $1 we spend, we need to make sure that the majority of the money we spend on the property is actually going into things that add value. So where people go wrong when they buy properties that are in need of a renovation is if they buy properties that have structural issues, for example, or they need to be rewired, or they've got huge piering issues, or all of these things that don't add value to the property because you can't see them, right? You can dump 50 grand into re-piering a house. You can dump 30 grand into rewiring a house. And all of this stuff is dead money, because when a buyer walks through, they don't know any of that. So we need to make sure that the fundamentals of the house are fine, and it's just cosmetic works that we're doing, which will actually increase the value of the asset.
Yep, great one. And then just another comment here. Actually, I'll take this one. Can you explain the tax implications of negative gearing? Negative gearing is just the concept where your deductions are more than the income. So you're creating this loss. If we're living and working in Australia and a normal Australian tax resident, then it usually just means you're going to get a nice big refund. And then what you're doing with that refund ideally is putting down the debt or paying off personal loans, just depends on the strategy. If you're an expat, then you won't have anyone here paying tax on your behalf. And if you're accumulating a loss each year on your property, well, just remember you're accumulating losses and they're carried forward into future years. Accumulating losses can be a great thing because an income loss trumps all other things when it comes to normal income as well as capital gains. So it just means you'll continue to carry forward losses, and often I refer that with my client as building a tax asset. At some point you'll cash in, whether it's through wage income or through making a capital gain on another asset. So I wouldn't say there's implications. I would just say you're either going to be accruing a loss and growing it over time, or you're going to be getting the benefit of a tax refund each year. Unfortunately, I do come across a lot of property spooker mobs which talk about positively geared properties and creating positive cash flow and all this crap. And unfortunately, the guys are just a big marketing engine in cahoots with a developer in the background getting paid big fat commissions, flogging property in absolute rubbish areas in the middle of nowhere. So just be mindful of those guys because they usually hold seminars in a lot of the capital cities, and they're sort of doing a seminar every week and saying that they've got the secrets to freedom when it comes to retirement and those sort of things. So be mindful of that. Another question here, which is a great one. Jeremy, over to you, mate, for this one. When I moved overseas for easier cross-border employment, I became a contractor. Can contractors, self-employed, get a mortgage? Question. And what about a large deposit stock portfolio question? So that's a bit of a two-parter.
Yeah, good question. So just had this conversation with a client recently. So with a contractor, there'll be two types of contractors that the banks will differentiate in terms of lending. One is someone that's, say, contracted to a big bank and they've through a third-party company, and the company will pay the invoice, or the company will invoice the employer, and then they'll pay the wage through and they'll withhold tax. So that is still a contractor, but that's still deemed as sort of PAYG. So that's not too bad in terms of your lending options. The second option is where you're a contractor, you're actually invoicing, perhaps you're paying some sort of local GST or VAT on your services. So that's actually more like a self-employed company that's engaging a client. That's falls under self-employed. Yes, there's lending options, just means we won't be able to really use a lot of the prime lenders. We'll have to work with, say, your mortgage managers that they have a place. It's going to come with a higher rate, but yes, there's a solution there. And the second question that you had around a large
deposit
dividend, a large deposit through dividends or shares, is that what you said?
No, it was more so there actually wasn't any context to the second part. That's okay. Is there generally for expats, do they require a sort of a minimum deposit amount that you're seeing with a lot of your lenders, Jeremy?
Yeah, so if it's your first purchase and we're not using equity and you're just using cash, there's a bit more flexibility. Banks are starting to come up to minimum 10% deposit, but ideally, I'd sort of aim for 20, maybe a 30% deposit, because it's going to give you the most lending options. But if that's, if you want to get into the market with a 10% deposit, that can be, there's some options there as well.
Yep. Yeah, great one. And then just last question for today, which is a tough one to answer. What is the ideal balance between property investments and other forms of investments? Ooh, it's a good one. It really depends. If I look at and if I survey my current clients now, especially the ones sort of the high net worth ones, property and having multiple properties is definitely one of their key formulas that's made them successful. And they haven't got nervous around when markets have been volatile. That's sort of when they've used our coaching and have swooped in for the kill. But often if you are investing in property and then you compare that to the size of your other assets, your property portfolio will be worth more than, say, your share portfolio and maybe even sometimes your super as well combined. But the reason for that is the gearing effect. Remember, when you're buying a property, you're only putting down 20% maybe deposit, maybe 25, and then the lender's giving you the rest, and then you're getting the uplift and the capital appreciation on the entire amount. You're putting down 200,000, but the property's worth $1 million, but you're getting a 5% return on the $1 million. So you're making $50,000 on that 200,000 that you put down. That's a fantastic return. You do that over 10 years, the compounding effect's incredible. But you've also got to have the stomach and be willing to be in it for the long run as well. So I guess there's no magic formula, because it's driven by goals, objectives, where we're working to. Do we have 20 years or do we only have 5 years? And what's going to be most important without taking on too much risk? So I can't really answer. There is no magic formula there. It is purely client by client, what their cash flow is, what their liquid asset situation is. That's a tough one. So that's all I can provide on that one. We might wind it up there. I'm mindful of the time, and I really appreciate everyone sticking on the line for today. If you do need a consult, you've seen some of those QR codes come up. That last one is just a meeting with Ben, our Director of Tax. If you need some tax advice regarding your expat situation, I think he'll be very busy when they look at updating those tax residency rules maybe in the next 12 months. This is just our socials. We post a lot, especially on LinkedIn and Facebook, a little bit there on Twitter, or not Twitter anymore, I shouldn't say that, and Instagram. As I said before, I'd highly recommend you get on LinkedIn and follow Jack's personal account, because he posts up a lot of case studies about his clients and how he's helping them, and especially that equity uplift. I know personally he's helped one of my clients recently, and the results were outstanding. So I'd highly recommend that. Outside of that, you can also connect with Jack at henderson.com.au, and that should bring today's webinar to an end. Really appreciate everyone dropping in today. Really appreciate our panelists as well, Jack Henderson and Jeremy Harper.
Thanks, everyone. Thank you.